how did we get into the financial crisis? And I think it starts with basic assumptions. It starts with an intellectual backdrop which has informed the way we do business and the way we think about the business cycle. Keynesian monetarist economics, that's really the backdrop. The business cycle cannot be eliminated, and that's what the Keynesians and monetarists have been about for a long time.
Now, you can't eliminate the business cycle. You can extend it, as they did throughout the 1990s.
And I think what you'll find is, as you look back at the 1800s, you had 1 to 2 year boom cycles and then a bust. 1 to 2 year boom cycles and then a bust. And we've expanded that out to being a 20, 30 year boom cycle. You can assume that it's 50 to 70% of that in terms of the bust side of the cycle.
The United States should have gone into what's happening right now, probably in the middle to latter part of the 1990s. But Alan Greenspan and the Fed came along and said, no, 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 we're gonna prevent this recession, and they pumped $5 trillion into the U.S. economy.
Now, we've been using bubbles to avoid recessions. Alan Greenspan, being the father of modern bubbles, has perpetuated that the most over the last 20 years because he's been around and doing his thing for at least that amount of time before Ben Bernanke took the helm.
Intentionally, they've used bubbles in order to avoid recessions.
U.S. stock values lost $2.6 trillion in the first 2.5 months.
U.S. stock values have dropped $11 trillion since September of 2007.
The U.S. financial markets are terrified of President Obama's tax and spending plans. U.S. stock market bubble, 1995 to 2000. You had Greenspan even say in 96 that this was irrationally exuberant. We had reached a point of greed reaching this pinnacle. You just couldn't see it going much further. And of course the stock market doubled from there. As most periods of greed do, they go to extremes.
We had the stock bubble first, 1995 to 2000. It burst in March of 2000. And from then till October of 2002, we saw the stock market drop $8.5 trillion. And many investors and retirees lose 50% or more of their retirement assets.
So that burst in March of 2000. And by October of 2002, there was $8.5 trillion lost.
That bubble, as it imploded, could have taken America down into a depression. But the Fed came in and they pumped more money into the system, and they knew exactly what they were doing. They were going to create the next bubble, and that was the real estate bubble.
U.S. foreclosures were up 30% in February of 2009.
U.S. banks are sitting on 700,000 unsold foreclosed homes.
The bailout of 7 to 9 million U.S. homeowners will not stop the U.S. real estate collapse. U.S. real estate bubble then ensued from 2001 to 2006 as a consequence of easy credit.
So we saw this incredible explosion in real estate prices, especially residential real estate prices. In fact, this was happening all over the world, not just in America.
That securitization process and the ease of credit led to the U.S. real estate bubble. That we are in a financial crisis comes as no surprise. We've just finished the greatest debt binge in world history, both private, corporate, and governmental.
This is a $53 trillion bubble, created mostly since 1980.
With government debt having risen in that period of time from $1 trillion to now $10.5 trillion. We actually have $10.78 trillion of official, now real-time debt. Risk is something that's difficult to assess if you assume that it doesn't exist. And what today's contemporary models in finance have done have assumed that it doesn't exist. And on that basis, we can lever up and take even greater and greater risks. What they're finding now is that they're wrong. They haven't done away with risk. Again, derivatives have been a major part of this.
The modern derivatives bubble is a creation of Wall Street, a highly leveraged paper pyramid.
As a result of the securitization process, as a result of ideas which led us to believe that we could eliminate risk, and in fact had eliminated all risk. The old phrase, trust but verify, verification's gone out the window. Who would have thought that AIG would have gone under, an insurance giant? Who would have thought that Lehman Brothers would have gone under? Who would have thought that Bear Stearns would have gone under? Who would have thought that Merrill Lynch would have to be bought out by Bank of America?
And the huge banks, the big banks, the Citicorps, the banks you're reading about in the headlines all the time, the big banks have trillions of dollars of exposure.
We have a $500 to $800 trillion derivatives market, and actually it's estimated as high as 1.2 quadrillion. Number that's hard to wrap your mind around, but 1.2 quadrillion on the upside in terms of what that market represents.
Let's say a hedge fund can put $5,000 down into global credit default derivatives and buy $100,000 worth of derivatives. And so this is where we are really seeing the world financial system come unglued.
Every major boom is usually followed by a bust. And in the context of that bust, you find that people have not been dealing with you fairly. This market grew exponentially as everyone assumed that it was just a place to make easy money. Now you've got the unwinding of those credit derivatives because we actually have had defaults in corporate America. Large U.S. banks have had huge exposure, and really this meltdown started to occur in September of 2007.
Number one problem today is this derivatives pyramid. We've got over $53 trillion in credit default derivatives alone, and those are now imploding, and they don't know how to stop this.
Not much changes as time passes. If you look back at the history of finance, if you look back at the history of markets, you find people who behaved almost like crime syndicates and organized crime. Wall Street today is really no different. Found ways to squeeze money out of everyone. And now the man on the street is beginning to protest. Protest because it's gotten to absurd levels. We've found our point of pain. We've been dealing with highly inaccurate financial and economic data. The government and Fed have been the chief exporters, if you will. I mean, what does every country export? We export garbage numbers.
I hesitate to say it, but I will say it. Government data for many, many decades on the economy has been highly distorted and actually dishonest.
And the current administration has even gone after the Census Bureau as a way to gain further control of the numbers, quote unquote. But these numbers have been the backdrop for assumptions investors have made, that GDP growth is positive, that inflation is low, that unemployment is low. And again, if those statistics are not legitimate, then the decisions you're making, assuming that they are, have to be re-looked at. What's interesting is if you look back at every major market peak in the last 200 years, most of them are marked by a tremendous amount of corruption. At the tail end of every major bull run, you've got people who are operating strictly out of greed. JP Morgan Chase, $90 trillion in derivatives exposure. Bank of America, $38 trillion. Citigroup, $38 trillion. Wachovia, $4.9 trillion. HSBC, over $4 trillion. Wells Fargo, over $1.5 trillion. I mean, again, when you're comparing $90 trillion to $1.5 trillion, Wells Fargo seems to get off light, but we're still talking about $1 trillion. We're still talking about $1.5 trillion of leveraged exposure to an ultra-frail market. That's just the absurdity of the place we've gone.